Hey guys, going to do something a little bit different today. I'm going to make a life insurance video and I'm going to take you on a little dive to actually go over how it works. How does life insurance work? I don't know that life insurance is more important than investments. It's just, it's more important to get it right the first time. With investments, if you're in the wrong place, you can just kind of move it, get into the right place. Whereas with life insurance, you usually make a decision when you're young, and then if you don't find out that it was the wrong decision until you're 10, 20 years older, and it's way more expensive. So this is a little bit of a dive. So what do we have right here? This is so that we can understand what we're dealing with. We are dealing with a hypothetical female, age 35, non-smoker. Why is she 35? Because I'm 35. I'm also pricing out a female because the idea behind this is to make this as inexpensive as we can. Females are less expensive to insure than males because females are usually smarter. We are covering this woman for $500,000 on a 5-year term. So first and foremost, what does a 5-year term mean? It means that that price is guaranteed for 5 years. The insurance company is contractually obligated to provide this life insurance for you for 5 years at this price, at a fixed price. And that price is $21.60 per month or $240 per year. They tend to give you a little bit of a discount when you pay annually just because they get all the money up front and they're theoretically investing that money and they're able to generate a little bit more of a return if they get it all up front. So the advantage to this one is that it's not very expensive. 21 bucks a month is not that bad for $500,000 of payout. What's the problem? Well, what happens after the 5-year term? Year 6, age 41, we're up to 32 bucks a month. Year 7, age 42, we're up to 44 bucks a month. Fast forward a little bit, age 60, $246 a month, $246.60 per month on a policy that started at $21.60 per month. It's just a lot of money. So how do we mitigate this a little bit? We go to example number 2. This is not a 5-year term. This is a 10-year term. We've lengthened the term. Now, instead of costing $21.60 per month, it costs $23.40 per month. So it's, $2 a month more expensive. But the trade-off is that the price doesn't go up for 10 years instead of 5 years. But then you still run into the same problem where, you hit year 11, price starts rising rather abruptly and unpleasantly. Do the same thing. We'll go to a 25-year term. Term's getting longer and longer and longer. Now you're spending $39.60 per month. It's a fair amount larger than $23.40 per month. It's larger upfront cost. Sucks in the earlier years. But now the price doesn't rise until you're 61. When do we opt for term? Because I'm going to talk about a different type. There's term and then there is permanent. We would opt for term. The advantage of term is that you can get a very large payout, a large death benefit. So while you are incredibly unlikely to die in your 30s, it would be catastrophic if you have a family or if you own a house with another person. Hypothetically speaking, if you have a kid, you're insuring yourself so that if you die prematurely, your surviving partner can have enough money to pay for childcare and pay for education and pay for whatever your values are. If you own a house, the payout will allow the surviving partner to stay in the house. A lot of times, if you've bought the house as a couple and one of you passes away, the bank will foreclose because they don't think that you're going to be, in the long run, able to pay the mortgage. So term is a relatively inexpensive way to get a very large payout. 2 problems. Number 1, once the term's done, everything starts to suck. The second problem is, if you don't die, you've spent all of this money and you have nothing to show for it on the other side. this is where permanent life insurance comes into play. What we are looking at here is hypothetical female, age 35. We are covering for $200,000, not $500,000. And the premium is way higher, $252.90 per month. What in the world? Why would it be so much more expensive when the death benefit is even less? Well, this is where we look down. There are two portions. There are two kind of sections to this life insurance policy. There is the death benefit, and then there is a cash value. So we go back to that age 60 where that price goes up. At age 60, your policy, which started at a $200,000 death benefit, is now a $274,000 death benefit. If you want to cancel at this time, people don't generally recommend canceling life insurance policies, but if you want to cancel, there's a cash surrender value. You have $102,000 in cash surrender value, which equals out to about a 4.86% return. That's a returns on life insurance policies are complicated. If you have questions about that, let me know. Consider this to be a kind of combination of an investment product and an insurance product. So if you die, you get a really dope payout, as if it was a 19% return, annualized. And if you don't die, you just want to cancel, you don't want to pay the premiums anymore, so you want to cancel your policy, you get a little bit of an investment return. Now you'll notice the investment return sucks if you try and withdraw early. That's because it's an insurance product and not an investment product. You're sacrificing some investment return to generate permanent life insurance and a cash surrender value in that permanent life insurance. Life insurance is important to get right early. I'm going to show you one last thing.